In the summer of 2003, a warehouse supervisor named Glenn watched the news every night. American troops were pushing into Iraq. Oil fields were burning. Anchors were interrupting each other with breaking alerts. Glenn was frightened in the way most Americans were frightened, not about combat, but about everything downstream of it. Gas prices climbing, grocery bills creeping, his 401k dropping. He did what felt logical. He moved everything out of the market and into a money market account until things settled down. He waited for things to feel safe again. He waited 11 months. By the time Glenn moved back in, he had missed one of the sharpest market recoveries of the decade. He never fully recovered the compounding time he lost. He retired at 68 instead of 63. He worked 5 extra years because a moment of completely rational fear cost him a decision that was completely irrational by the numbers. 3 blocks away from Glenn's house, a commercial electrician named Howard did something different. Howard did not watch the news that summer. Not because he was uninformed, but because he had read something the year before that changed the way he thought about geopolitical conflict and money. Howard moved nothing. He kept his automatic contributions running. He added a modest position in an energy index fund when oil started spiking. He kept working, kept investing, kept ignoring the noise. By 2008, before the financial crisis arrived, Howard had accumulated $460,000 in retirement savings. Glenn had $112,000. Same neighborhood, same income range, same war on the same television. 2 completely different outcomes separated by one thing. Howard understood something Glenn did not. War creates winners and losers in financial markets with a predictability that almost nobody talks about in polite company, and the people who end up on the losing side are almost never the ones who deserve to be there. This is not a story about whether any war is just or unjust. It is not a political argument. It is not a commentary on foreign policy in the Middle East or anywhere else. This is a story about a pattern that has repeated every single time a major conflict has pulled American economic attention into a prolonged military engagement. A pattern that is running right now as tensions between Iran, Israel, and the United States reshape global energy markets, defense budgets, and the quiet architecture of American household wealth. Most people are watching this unfold the way Glenn did. With fear, with confusion, with a sense that the smartest move is to wait it out. And the people who understand the pattern are doing what Howard did, quietly positioning themselves while everyone else is frozen. Here is what this video will show you. War economies do not destroy wealth equally. They transfer it. Every dollar of purchasing power that evaporates from a working family's grocery budget materializes somewhere else as profit. Every spike in energy costs that tightens a household budget expands a balance sheet in Houston or Riyadh or on a trading floor in Lower Manhattan. The war economy trap is not a conspiracy. It is a mechanism. It is a set of predictable financial forces that activate every time large-scale military conflict reshapes energy supply chains, government spending priorities, and investor behavior simultaneously. The trap has 2 jaws. The first is what happens to your money automatically if you do nothing. The second is the opportunity cost of not understanding what to do instead. By the end of this, you will understand both. Let me start with the first jaw of the trap. What war does to the cost of being an ordinary American and why it functions as an invisible tax on people who are not paying attention. Every major American military engagement in the Middle East in the past 4 decades has produced a version of the same sequence. Conflict or the credible threat of conflict disrupts oil supply chains. Oil prices spike. Energy costs cascade through every layer of the economy because nothing moves, nothing gets manufactured, and nothing stays cold without energy. Inflation accelerates. The Federal Reserve faces pressure to respond. Interest rates move. The cost of carrying debt increases. Consumer purchasing power compresses. And ordinary Americans who did nothing wrong find that the same paycheck buys measurably less than it did 12 months earlier. This is not hypothetical. When Iraq invaded Kuwait in August of 1990, crude oil prices doubled within 4 months, moving from approximately $17 per barrel to over $40. American consumer confidence dropped sharply. The economy entered a recession. Working families absorbed that shock entirely because they had no hedge against it. After the invasion of Iraq in 2003, crude rose from around $30 per barrel to over $55 by 2004 and above $100 by 2008. During that same period, the average American household spent between $1,200 and $2,000 more annually on energy-related costs. That money did not vanish. It moved. To oil producers, to energy companies, to the shareholders of every company sitting at the intersection of conflict and commodity. The Iran-Israel conflict, with the United States drawn into its orbit through military assets, logistical commitments, and the permanent reality that the Strait of Hormuz handles roughly 20% of the world's liquid natural gas and about 17% of global oil trade, runs the same mechanism. Any sustained escalation that threatens transit through that strait does not just create headlines. It creates an energy price shock that taxes every household in America without a single vote being cast or a single law being passed. This is the first reason most Americans lose in a war economy. Not because they make bad decisions, because the structure of the economy automatically extracts purchasing power from consumers and delivers it to producers every time energy supply becomes uncertain. Here is what most people don't realize about the second layer of the trap. Government war spending does not come from a separate pool of money that appears during conflicts. It comes from deficit financing that eventually expresses itself as inflation and debt service costs that crowd out domestic investment and social spending for years afterward. According to research from Brown University's Costs of War project, the United States spent over $8 trillion on post-9/11 military engagements when long-term costs including veteran care and debt interest are included. That spending was financed through borrowing. That borrowing added to the national debt. That debt creates interest obligations that compete with every other budget priority for decades. The economic hangover from a major military engagement lasts far longer than the engagement itself. Ordinary Americans absorb this hangover through reduced public services, higher eventual taxes, and an inflation environment that persistently erodes the purchasing power of savings and wages. The people who profit from the engagement itself, defense contractors, energy producers, logistics companies, financial intermediaries handling defense contracts, face no equivalent erosion. Their profits are captured in the years of high spending. The costs are distributed across the population for a generation afterward. This asymmetry is the core mechanism of the war economy trap. Here is where it gets interesting. The trap has a second jaw, and this one is entirely optional. You do not have to be on the losing side of this transfer. The same forces that erode the purchasing power of uninformed or paralyzed savers simultaneously create measurable, historically documented opportunities in specific asset classes. Defense spending during conflict periods is among the most reliable economic forces ever recorded. Lockheed Martin stock returned over 170% between 2001 and 2005. Raytheon returned over 140% in the same window. Northrop Grumman more than doubled. General Dynamics rose over 160%. These were not obscure investments requiring insider knowledge. They were publicly traded companies whose core product, defense technology and weapons systems, was an extraordinary and federally guaranteed demand. Energy companies follow a similar pattern during Middle East conflicts. The S&P 500 energy sector returned over 200% between 2002 and 2008 as oil climbed from the 30s to over $140 per barrel. The households that were absorbing higher gas prices were also, if they were paying attention, able to hold the companies collecting those higher prices in their retirement accounts. Most did not. Not because the information was hidden, because nobody explained the mechanism clearly enough, and because watching your grocery bill increase does not psychologically prime you to think about where that money is going. Gold behaves with notable consistency during geopolitical uncertainty as well. During the Gulf War of 1990 through 1991, gold rose approximately 15%. During the years of sustained Iraq and Afghanistan conflict, gold climbed from around $270 per ounce in 2001 to over $1,000 per ounce by 2009. It crossed $2,000 per ounce during the pandemic and has continued climbing as geopolitical uncertainty has remained structurally elevated through 2025. Investors who held even a modest allocation to gold as a portion of their portfolio throughout these periods experienced meaningful protection against the inflation and currency stress that eroded the savings of people who held only cash or bonds. Defense, energy, and gold are not the only forces activated in a war economy. But they are the three most historically consistent and the three most accessible to ordinary investors through standard index funds and ETFs available in any brokerage or retirement account. Rule 1. Stop reacting to conflict emotionally and start analyzing it economically. The financial media is designed to generate fear because fear drives engagement. Every breaking alert about Iranian naval movements or Israeli air operations or American carrier group deployments is engineered to make you feel that something must be done right now. That urgency is the trap. The correct response to geopolitical conflict is not speed, it is clarity. Before you move a single dollar, ask 3 questions. What does this conflict do to energy supply chains? What does this conflict do to defense spending? And what does it do to the dollar and inflation? Those three questions determine the financial landscape. Everything else is noise. Rule 2. Understand the difference between market volatility and market damage. When conflict escalates, markets drop. They always drop initially. The Gulf War produced an immediate equity market decline. 9/11 produced an immediate equity market decline. The Iraq invasion produced an immediate market disruption. Every single one of these declines was followed by a recovery. The S&P 500 has never failed to recover from a geopolitical shock and go on to reach new highs. This is not a guarantee about the future. It is an observation about 100 years of history that includes 2 world wars, a Cold War, the Korean War, Vietnam, multiple Middle East engagements, and dozens of smaller conflicts. Investors who confused volatility with permanent damage lost money not because war destroyed their assets, but because they sold during the decline and failed to participate in the recovery. The person who held through the 9/11 decline and the subsequent recovery saw their portfolio recover fully within roughly a year and continue compounding for 2 more decades. The person who moved to cash in October of 2001 waited to feel safe and bought back in at higher prices after missing the recovery entirely. Rule 3. Identify which sectors the war economy enriches and gain exposure before the enrichment is fully priced in. Defense contractors receive congressional budget authorizations that move through committees on timelines that are largely public. When a sustained military engagement becomes clear, supplemental defense appropriations follow within months. The companies holding the relevant contracts, aerospace and defense manufacturers, cybersecurity firms serving military clients, satellite and communications infrastructure providers, see revenue increases that are government-guaranteed and inflation-resistant. Gaining exposure to a broadly diversified defense or aerospace index fund when a conflict moves from skirmish to sustained engagement has historically produced returns that significantly outperformed the broader market over the following 2 to 3 years. This is not speculation. It is following documented government spending to its destination. Energy sector positioning works similarly. A conflict that structurally threatens Middle East oil supply routes does not produce a 1-week oil price spike. It produces sustained elevated prices that flow through to energy company earnings for the duration of the uncertainty. Broad energy sector exposure, not individual companies but diversified sector funds, captures this dynamic without the risk of any single company's operational issues dominating the outcome. Rule 4. Treat inflation as a design feature of the war economy, not a surprise side effect, and hold assets that appreciate when inflation rises. The mechanism is straightforward. War spending increases government debt. Increased debt creates money supply pressure. Money supply pressure produces inflation. Inflation erodes the real value of cash and fixed-rate bonds. Inflation raises the nominal value of real assets. Real estate, commodities, inflation-protected securities, equities in companies that can raise prices alongside their own input costs. Someone holding $50,000 in a savings account earning 2% while inflation runs at 6% is losing 4% of real purchasing power annually. Someone holding that same $50,000 across real assets is, at minimum, keeping pace with inflation and potentially outpacing it. The households that most severely damage their wealth during war economies are the ones holding large amounts of cash outside of tax-advantaged accounts while inflation silently consumes its value. The households that protect themselves are the ones who understand that in an inflationary environment, cash is not a safe harbor. It is a melting asset. Rule 5. Do not mistake your inability to predict the duration of conflict for an inability to position for its financial effects. Investors routinely make the mistake of refusing to act because they cannot predict when a conflict will end. That prediction is not required. The financial effects of a sustained military engagement, elevated defense spending, higher energy prices, inflationary pressure, dollar volatility are present throughout the engagement regardless of its end date. You do not need to know when the Iran-Israel-America conflict resolves to understand that for the duration of its relevance, defense and energy spending will be elevated above pre-conflict baselines. Positioning in that direction does not require a precise timeline. It requires only the observation that the direction of spending is clear even when the duration is not. Now let me show you what the difference between these two approaches looks like across 2 people navigating the current environment. Christine is 41 years old. She earns $94,000 annually, has $87,000 in a 401k invested in a standard target date fund, and carries a mortgage at 4.25%. when tensions between Iran and Israel escalated significantly in late 2024, and the United States increased its naval presence in the region. Christine did what Glenn did in 2003. She got scared. She moved 30% of her retirement portfolio to the money market option inside her 401k. She reduced her monthly contributions from 8% to 3%. She told herself she would move back in once things settled down. 12 months later, she had missed an 8% market gain on the 30% she moved out. Her reduced contributions meant she also declined an employer match worth roughly $2,400. In total, her caution cost her approximately $12,000 in foregone gains and uncaptured matching contributions over a single year. The conflict had not resolved. Things had not settled down. They may not settle down for years. Christine is still waiting. Now meet Robert. Robert is 40 years old. He earns $89,000 annually and started in nearly the same position as Christine with $82,000 saved. When escalation became clear, Robert read about the historical financial patterns of Middle East conflict. He kept his full contribution rate running. He did not change his target date fund allocation. He added one modest change. He opened a separate taxable brokerage account and began contributing $300 monthly to a broad aerospace and defense index fund and $200 monthly to an energy sector index fund. He kept his emergency cash fund fully stocked. He kept his mortgage payment unchanged. He made no dramatic moves. He simply added $250 per month in diversified exposure to the sectors that historically profit from the economic environment a sustained conflict creates. Over 5 years at conservative return assumptions, Robert's additional positioning adds between $42,000 and $68,000 to his net worth above what Christine's paralysis produces. They started in the same place. The gap is not income. It is not intelligence. It is the difference between reacting emotionally and responding economically. Here is the action plan based on everything the historical pattern reveals. This week, audit your current portfolio allocation and identify how much cash or near cash you are holding outside of a legitimate emergency fund. If you have moved money to cash or money market accounts in response to geopolitical anxiety, calculate what that decision has cost you in foregone returns since you made it. The number is usually larger and more clarifying than people expect. This month, if your 401k offers a total market index fund, an S&P 500 fund, or any broadly diversified equity option, ensure your automatic contributions are flowing there rather than sitting in stable value or money market. The historical record on staying invested during geopolitical conflict is unambiguous. Being out of the market feels safe and produces financially catastrophic outcomes over time. This quarter, if you have discretionary capital beyond your emergency fund and fully funded retirement contributions, research whether a modest allocation to a defense and aerospace index fund or an energy sector index fund fits your overall strategy. These are not speculative positions. They are broad sector funds holding dozens of companies, available through any major brokerage, accessible inside many 401k platforms. The allocation does not need to be dramatic to be meaningful. 5 to 10% of investable assets in inflation-resistant, conflict-relevant sectors provides meaningful protection and upside exposure without concentration risk. This year, evaluate your inflation exposure honestly. If your savings outside retirement accounts are sitting primarily in traditional savings accounts earning below inflation, consider whether I-bonds, Treasury inflation-protected securities, or a broader real asset allocation makes sense given the inflationary environment that sustained conflict reliably produces. The goal is not to become a geopolitical analyst or a defense industry expert. The goal is to stop being the person who absorbs the cost of a war economy without participating in any of its financial upside. There is something deeper underneath all of this that deserves to be named directly. The reason most ordinary Americans end up on the losing side of a war economy is not that the information is hidden. It is that the entire structure of financial media and cultural conversation around conflict is designed to produce paralysis in ordinary people while informed capital moves quietly in the opposite direction. Fear is the product that cable news networks sell because fear keeps people watching. Paralyzed people make no financial moves and therefore cannot make the correct financial moves. The households that built meaningful wealth during previous conflict periods did not have access to secret information. They had access to the same observable reality that everyone had. They just refused to let the emotional temperature of the moment override the economic logic of the pattern. The war economy trap is not designed by any individual or institution. It emerges from the interaction of fear, spending, inflation, and capital allocation in a system that does not distribute information, access, or education equally. The people who understand the pattern keep getting richer during conflicts. The people who do not keep absorbing the costs without capturing the benefits. That asymmetry is not inevitable. It is a choice that either gets made consciously or gets made by default. History doesn't announce itself as a wealth transfer. It just moves money from people who are watching the news to people who are reading the balance sheet. Now you know which side of that transfer you want to be on.